So, gold just blasted past $4,000 an ounce. Your newsfeed is probably blowing up with stories calling it the ultimate safe haven, the one asset that can protect you from all the chaos. But what if the billionaire investors and central banks who rode this wave all the way to the top are now using this celebration as cover to quietly sell? The real story isn't that gold hit $4,000. The real story is where that smart money is moving next. And I'm about to show you exactly what the data is revealing. Look, it's no secret why gold has been on an absolute tear. The price has surged over 45% in 2025 alone, completely crushing the S&P 500's return. This historic run was lit by a perfect storm of geopolitical tension, a shaky US dollar, and fears of a government shutdown. On top of all that, central banks around the globe have been buying gold at a historic pace, desperate to diversify away from the dollar after they saw what happened to Russia's frozen assets. It all makes perfect sense. The headlines write themselves. But here's the trap. Relying on yesterday's news is how the average investor gets left behind. The financial elite, the smart money, don't get rich by following the crowd. They get rich by seeing the next move before anyone else does. As everyday investors pile in, terrified of missing out, you have to ask yourself, are we at the peak of the party, or is there still room to run? There's a classic saying on Wall Street: when your Uber driver starts giving you tips on gold, it might be time to get cautious. That kind of widespread excitement often signals the late stage of a rally, where the people who got in early are already eyeing the exit. So, the real question isn't why gold hit $4,000. It's what are the people who saw this coming years ago doing right now? Are they doubling down, betting on 5,000 or even 6,000 gold? Or are they taking their profits and rotating into the next big trade? To figure that out, we just have to follow the money. First, let's talk about the biggest players in the game, central banks. They have been the absolute bedrock of this gold rally, buying at a record breaking pace. They snapped up over 1,000 tons in both 2022 and 2023, and that strong trend continued into 2024, a rate more than double what we saw in the last decade. This was a massive global shift to de dollarize, and the buying has continued in 2025. In the first half of the year, 23 countries padded their gold reserves. Poland led the pack, with China, Kazakhstan, and Turkey also adding to their stacks. Just recently, the Bank of Korea even announced it's thinking about buying gold for the first time since 2013, specifically citing it as an alternative to the US dollar. This all sounds incredibly bullish, doesn't it? But here's the little detail the headlines are missing. The pace of their buying is slowing down. Data from the World Gold Council for the third quarter of 2025 shows that net purchases fell to just 90 tons. That's a huge drop from the quarterly average of over 200 tons we saw throughout 2024. So, why the slowdown? It's simple. Central banks are price sensitive too. As Morgan Stanley analysts pointed out, the more gold's price climbs, the less they need to buy to hit their reserve targets. One report even put it bluntly: a major pillar of support for gold is weakening. So the story here isn't that central banks have stopped buying. They haven't. The story is that the frantic, record shattering accumulation is cooling off at these new, higher prices. They're becoming more opportunistic, buying the dips instead of chasing the rally. This suggests that while they're still committed to gold for the long haul, they don't feel the same urgency to buy at $4,000 an ounce. The rocket fuel they provided for this rally is turning into more of a steady burn. Next up, let's look at the hedge funds and big institutional investors. We can peek into their playbook by analyzing their quarterly 13F filings, which show us what they're buying. And the latest data tells a really interesting story of rotation. While a lot of funds are still holding gold, we're seeing some subtle moves happening under the surface. A recent batch of filings for the Big Gold ETF, GLD, showed that just as many funds were cutting their positions as were adding to them. On top of that, major ETFs like GLD actually saw net outflows of over $1.5 billion in October 2025, which is a clear sign that some investors are cashing in their chips. This isn't a mass exodus, but it's definitely not a sign of everyone piling in either. What we're seeing is a strategic repositioning. Some of the smart money isn't just selling gold, they're swapping it for assets they believe have way more upside in the next phase of the economy. So, where's the money going? The data points to a couple of key areas. First, there's a clear stampede into the industries that are going to power the future. Early reports on venture capital for 2025 show a fire hose of cash aimed at US startups, with a huge chunk, some estimates say more than two-thirds, targeting AI focused companies. That is a massive long term bet on a world changing trend. Second, We're seeing a pivot towards the raw materials needed for this tech revolution and the green energy transition. The soaring demand for electricity, powering everything from AI data centers to electric vehicles, is creating an incredible setup for two key metals, copper and uranium. Tech giants are now signing deals to power their energy guzzling AI data centers with nuclear energy, sparking a renaissance for uranium. Global demand for uranium is projected to skyrocket, but supply has been tight after a decade of underinvestment. It's a similar story for copper, which people are now calling the green metal. It's the backbone of everything from EV motors to our entire electrical grid. Analysts at S&P Global predict copper demand could nearly double by 2035, driven almost entirely by the energy transition. So while gold has been a great defensive move, these industrial metals are looking like the next big offensive play, set to ride a new wave of global infrastructure spending. This rotation tells us something big about how the world's sharpest investors see the future. The winning trade for the last 2 years was defensive, hedge against inflation, chaos, and a weak dollar. Gold was the perfect tool for the job. But the next trade looks to be about building the future. It's a rotation from pure safety to productive growth. Smart money is flowing into the sectors that are essential for the next decade of innovation: AI, the energy transition, and the raw materials that make it all happen. Think about it this way: gold is portfolio insurance. It protects you when things go wrong. But assets like copper, uranium, and AI infrastructure are portfolio engines. They're designed to build wealth as the world innovates. The shift we're seeing in big money portfolios suggests that while risks are still out there, the biggest opportunities are no longer in just hiding from the storm, but in financing the solutions. This doesn't mean the case for gold is dead. Far from it. Major banks like JP Morgan and Morgan Stanley still see gold possibly hitting anywhere from $4,400 to over $5,000 by 2026. But the urgency has shifted. The big, fast money has already been made. Now the focus is turning from what protected your wealth yesterday to what will actually grow it tomorrow. So, what does this all mean for you and your money? First, it means that while holding gold has been a brilliant move, the smart money is already playing a different game. They aren't ditching safety, but they are rotating towards assets positioned to win in the next chapter of the economic cycle. It suggests now is the time to look at your own portfolio and ask, am I only prepared for yesterday's crisis, or am I positioned for tomorrow's opportunities? This is not me telling you to go out and sell all your gold. Let me be clear. The big picture reasons for owning gold, geopolitical risk, central bank diversification, are still very much in play. However, the data strongly suggests it might be a good time to reevaluate how much you have. If you've enjoyed this massive run up, it could be smart to consider trimming some profits and rebalancing your portfolio. Think about what this rotation implies. If giant institutions are moving into AI, green energy, and critical metals like copper and uranium, it signals a belief that despite all the gloomy headlines, there's a real path forward for growth and innovation. For an individual investor, this might mean making sure you have some exposure to these themes. Are you invested in the future of energy? Do you have a stake in the tech infrastructure being built right now? The key takeaway is diversification. The smart money isn't making an all or nothing bet. They are blending their assets for a new environment. They're keeping their insurance policy with gold, but they're also placing smart bets on the engines of future growth. By the way, if you're finding this kind of analysis valuable and you want more deep dives that go beyond the headlines, do me a favor and hit that like button, and make sure you're subscribed so you don't miss what's coming up next. So, while the front pages are celebrating gold hitting the historic $4,000 mark, the real actionable story is happening just beneath the surface. The smart money isn't throwing a party, it's reallocating capital. The explosive, fear driven rally has matured, and the focus is shifting from pure defense to strategic offense. The central bank buying frenzy is cooling down, and institutional investors are starting to rotate into the technologies and commodities that will build the next decade. Gold will likely remain a core holding for anyone seeking stability, and many analysts still see some upside. But the frantic rush for it is over. The new rush is into the assets that will power our future. Now, I'm curious to hear what you think. Do you believe gold is on its way to $5,000 and beyond? Or do you agree that the smart money is already moving on to the next big play? Let me know your thoughts in the comments below. I read every single one. Thanks for watching.